Harsha Upadhyaya joins us. Let's take a conversation forward. Let's understand from him what he makes of the market mood and what he makes of the architecture. Harsha, good morning. Thank you for joining us. Last week it was IT. This week it is HDFC Bank. How would you right now map the market mood for us?
Good morning, Nikunj. Clearly, what we have seen in the early part of this earnings season, some of the moves have been very, very exaggerated. Not that the results or the internals that were given out merited that kind of exaggerated moves across the board. This also shows that probably we are no more in a trending market. We are probably close to an inflection point in the very short term. Given that the valuations have moved up in the recent times with strong performance of Indian equities, it's possible that we will probably get into a consolidation or a correction in the very short term.
Okay. So what would you attribute, let's say, a fall in HDFC or a polycap to? Do you think this market is now showing signs of nervousness if the reaction is so exaggerated? Historically, it means that bulls are getting tired.
Yes, Nikunj, that's what I was trying to explain. Some of the moves, whether in the IT pack initially or some of the banking names yesterday, etc., how they reacted, shows that people could be nervous at these valuations. It may not be related to stock specific valuations, but just the valuations overall in the market clearly are putting weight, and that's what is leading to this kind of volatility in our opinion.
The kind of indications we got from HDFC Bank, and this is India's biggest bank, that is an indicator of where the sector is headed. And India's biggest bank has said the following, which is that there is pressure on liability, and if there is pressure on liability, growth has to slow down. Now, obviously, HDFC Bank is a representation of the sector. So my point is that would you read yesterday's or day before yesterday's HDFC Bank numbers as more like a profit warning for the entire sector per se?
Nikunj, definitely it's one of the important statements that has come from the leading bank, I would say. And we all know that deposit growth has been lagging for quite some time. This leads to a bigger question. If we are looking at economy growing at 7.5% over the next few years, investment cycle reviving, who is going to fund that credit growth? If you look at debt mutual funds have not been receiving any inflows post the taxation change that happened this financial year. We have not seen any interest from retail public into buying debt papers. We have already seen deposit growth slowing down considerably in case of banks. If this is the situation, if corporate India needs debt, who's going to provide that debt is the question that we need to ask. And in case we believe that this is going to be a systemic issue, then probably the kind of growth rates that we are expecting in the economy could also come under question. But these are early days. Definitely, we need to keep watching this in terms of how it moves over the next 1 or 2 quarters.
Harsha, now let's take that point forward. So if banks slow down and if they don't lend growth, that means economy will slow down because banks are like the early indicator. If banks are slowing down, that means economy will slow down. That means earnings will slow down. Everything will slow down.
Yes, yes, Nikunj, one could make that argument, but as I said, these are too early days to conclusively say that that's how market is going to go towards or economy is headed towards. Yes, we need to remember that credit growth is very important for any economy to sustain the growth, and that's where we need to closely watch these numbers going ahead.
Harsha, the other question really is this the sort of tipping point where the markets would fall under its own weight? And it's not just us, you are seeing a global readjustment of sorts because of the unwinding of the dollar trade, I guess, also, wherein a cluster of emerging markets has seen an FII sell-off as of yesterday. So just wondering whether you need to go cautious and maybe profit take within small and mid caps also right now. Was 22K the near-term peak that we saw day before?
Sure, clearly the valuations have been on the higher side, especially as you go down the capitalization curve or as you go down the liquidity curve. And that is something that every investor has to remember because the kind of up move that we have seen over the past year or past 3 years with hardly any volatility cannot be a normal course of things for equity markets. Equity markets are always volatile. You will see ups and downs, but that has not happened over the last couple of years. And that has simply made more investors come into the market without realizing how volatile equity markets could be. Having said that, at this point of time, at least, we are not seeing very big reversal in terms of flows, whether it is domestic or foreign flows. In fact, domestic flows have continued to be very strong. We have got SIP numbers which have been making record numbers every month. So very unlikely that anything drastic would happen on the domestic flow side. But we need to keep looking at what happens on the foreign liquidity perspective. These are some of the moves that will put some pressure on the market if it reverses. But at this point of time, we have not really seen any big change.
Also, the biggest and most popular trade of last year, or up until actually Monday, was PSUs, right? That juggernaut, and I'm going to keep banks outside of that basket right now. They've moved along just so nicely. So many themes, be it defense, railways, power. Just the entire PSU pack has moved just so nicely. Over there also, would you say that, go a little easy, maintain caution, maybe take some profit off the table?
Aisha, PSU pack is not a homogeneous pack. There are different business segments that these companies are working under. So many of them have moved up in terms of valuations, which may be rich compared to their own historical valuations. And that's where one needs to be cautious. But there are pockets even there where valuations are still not as rich as what you could call it expensive. So to that extent, probably a complete profit booking from that basket may not be required at this point of time. But again, you need to go a little more stock specific. I think the uniform rally that we saw across PSUs may not continue for long.
Also wanted to understand your outlook then on the overall election impact. And do you believe that maybe we can see some of the capex related themes taking center stage on the back of this, looking at an overall manufacturing boom as well?
Clearly, from a medium-term perspective, manufacturing and infrastructure will remain key focus areas for the government. So to that extent, the kind of investments that are outlined will continue to go into these segments, and the policy push will also continue. So to that extent, one could have a reasonable exposure in the portfolio from a medium to long-term perspective. Having said that, I would say many of these segments also are at a reasonably high valuations. So in the short term, one cannot expect the same kind of up move that we have seen in the past few quarters.
Harsha, so how do you see market then moving in the light of where election cycle is? I mean, these days a small news or one missed quarter is causing a 10% volatility in stocks. So election cycle is going to be a volatile event, so to speak. How does one approach it? Just do nothing or buy some puts, raise some cash?
Nikunj, if you look at elections from a 15-20 year perspective, then probably you will not even notice what has happened during those election periods. And many a times, the initial reaction that happens post verdict may not give you any indication in terms of how the next 5 years are going to be. Look at what happened in the 2004 election result day or in 2009. So clearly, one should not base all our opinion based on the initial reaction that market gives just after the election verdict comes out. Coming to 2024 elections, I think what will be crucial is at what level we will be entering the election phase. If you are entering already at a very high valuations, probably even with an outcome which is more or less in line with expectations, you could still see profit booking. Or if there is a disappointment, probably the cut is going to be very large. So it is very crucial to see at what level you are entering election and whether markets have more room to go up or go down at that point of time. At this point of time, assuming that election results are going to come out tomorrow, I would say that the risk from a medium-term perspective is a lot lesser on the large caps as compared to the small caps. So that's how I would read the markets in terms of valuations at this point in time.
The thing also I wanted to talk about was IT. Has it come as a surprise? I mean, it was a oversold, biggest avoid perhaps going into the earnings season, and I guess that's why even inline set of numbers give you a lot of room for surprise on the upside. What's been your reading of so far what we've heard from IT commentary?
Aisha, clearly, I think this is something to do with how the stock positioning was at the broader level. If you look at broadly, the banking results or the IT results have been broadly in line. I won't say that exactly in line, but broadly in line with a little bit of positives on the IT side, a few negatives on the banking side. But we have seen how the markets have reacted on these results. And it's not just on few stocks, but on the entire sector. So to that extent, clearly, market is showing a lot of nervousness in terms of the current overall high valuations, in our opinion. As far as IT sector itself is concerned, there is likely to be a Fed rate cut that's going to happen sooner than later, and that should also be positive for IT sector from a business perspective as well as from a valuation perspective. And we think that over the next 2-3 quarters, probably you will start seeing some improved momentum. But at this point of time, I mean, I can't say that the entire move that we have seen in the sector is driven only by fundamentals in that sense. It is also due to how most of the institutional investors were positioned in this sector.
That we have seen a lot of leeway being made when it comes to the auto space, be it the PLI scheme, the focus on EVs. What are some of the key growth drivers for autos according to you down the year, Harsha?
Autos, by and large, seem to have turned corner. If you look at most of the subsegments within auto, with an exception of tractors, we are seeing decent demand trends. I think the new product introductions that have happened in the passenger vehicles and two-wheelers have definitely excited the consumer segment, and we are seeing a strong demand trends in both of those segments. Tractors have seen some weakness in the recent times. Probably that would continue for the rest of the financial year as well. And also one needs to closely look at next year's monsoon. After having one efficient monsoon, second monsoon is going to be definitely very crucial for the tractor segment. Apart from tractors, we continue to remain positive on most of the other automobiles.
I'm so glad you could join us.
Thank